Well, every time it looks like we can get back into South African shares, it is like that movie Jaws. It's never really safe to get back into the water. But in the last month, things have looked a little different. Andrew Vintcent is one of those waving the proudly South Africa flag when it comes to investing in JSE-listed stocks. And ClucasGray, the company that he works for, has just launched a brand new South Africa-only unit trust. It sounds foolhardy if you're in the Magnus Heystek camp, but Andrew will be telling us why it isn't. Andrew, maybe let's start there. Magnus Heystek, do you actually take seriously what he has to say? He's been a perennial bear on South African stocks.
Hi, Alec. Thanks for having us on the show. Yeah, one has to. I mean, I think he's highly acclaimed, and I don't know Magnus personally. I have read much of his work, and he's obviously expressed his views eloquently, and the last 10 years have proved to be correct. I guess if you go back the last 10 to 12 years, it's been a very, very difficult time in South Africa. The debate we all have, and I think we all have to have as investors, is whether these are cyclical or structural. And events of the last 6 months, 6 weeks, if you include May, 5, 7 years, if you go back to Nenegate, there's some evidence that arguments in favor of the structural camp can be quite compelling. And history will always be the judge on these discussions and debates. The discussion, the view we've gone with is that this is part of a typically more cyclical and structural. And have we been here before? We believe there's lots about the current cycle that we're living through that rhymes with the past, and we can point to numerous periods over time where similar existential threats have existed in South Africa, and it's often correlated with a very difficult global backdrop. And I think what we're missing, given the dominance of performance of a very few US large cap shares, we're missing the fact that it's been a very difficult global backdrop over the last 12 to 18 months and even slightly longer. So I think it would be foolish of us to dismiss views like those expressed. But at the same time, we think a lot of that negativity is more than adequately priced into the current investment landscape, and we can expand on that if you wish. We're just caught in a very difficult period right now, but we think that there's lots that is cyclical more than structural.
It's good to get context in that respect. But looking through the roadshow that you did last month, the slides, and thank you for sending and sharing those with me. Load shedding is a very big issue, and just today we've had news that Jan Oberholtzer, who looked to be the last adult in the room at Eskom, has now left. I had an interview with him, a lengthy interview, about an hour's long, where he unpacked the issues he was dealing with. He's a veteran at Eskom, former chief operating officer, kept on for 2 years to do the hard yards, to bring into the production the issues that we need to stop load shedding, and now he's gone. Now, I'm not sure what's behind that, whether he perhaps was a little outspoken in our discussions and somebody used that opportunity to eject him. But your view now on load shedding, given that Oberholtzer says, and really the key to all of this is he says that when he was the chief operating officer, Eskom spent 6 billion rand a year on diesel to keep the load shedding at bay. He said in the first 3 months of this year, April, May, June, 9 billion rand was spent. So in other words, the utility was investing very heavily in diesel. Maybe somebody's woken up and said, oops, we can't carry on indefinitely. But your view now on load shedding against that backdrop?
Look, I mean, you've articulated very well the issues. We don't know the individual, and the load shedding has been, I guess, an own goal. We talk about an own goal of seismic proportions, which makes this cycle a little bit different to every other cycle that we've experienced, because you've had the cloud of load shedding over everything else, which is relatively typical of the cycles we're living through. The load shedding is this unique variable. We don't know what solves load shedding. We hear from certain specialists, some of which have been, many of who have been on your show, that there's a significant amount of capacity coming back on stream. We're not here to fly a flag for Eskom. We think it's clearly in a difficult space for the reasons that have been well articulated. I think what the point we do make in that article, that slide deck I shared with you, and some of the articles we've written, is that we think that the 2023 earnings cycle is going to be particularly difficult given the extra cost that companies at an underlying company level are having to make to stay open and stay in business. And it's that issue that we think is one that needs to be fleshed out. So every company is now doing what it can, be it a small business, a household, a large corporate, is doing what it can to get off the grid and to make themselves energy independent. But the cost of getting through this period before you get to that independent stage has been very expensive. And you've all read the headlines with the food retailers, food producers, and the amount of money they're having to spend at a company level and expense through earnings into these results. So I guess the point we're making as investors is to try and understand what a post load shedding earnings cycle would look like for these companies. And we did an exercise during the COVID crisis, which is the previous. I mean, these crises come thick and fast, sadly, in globally, but also more so in this country. These crises have forced us to think quite differently around how to value companies. And if you had taken the COVID earnings base as the sort of normalized earnings base for any company, you would have got the wrong answer. So we try to look forward 2 to 3 years and see what a more normal cycle would look like. We believe we're forced to do the same right now because there are so many of these one-off costs that companies are absorbing, and into 2024 and 5, a number of those will fall away. What that means for Eskom is a whole separate debate. And we ultimately company investors, we're trying to work out what's the best for a company. So we think that the cost base of these companies will normalize quite dramatically off a very elevated 2023 base. And so we've looked at 24 and 25 earnings as best we could to see what valuation multiples we're currently paying for those companies. And the outcome is illuminating and in many cases very enticing from a valuation and prospective returns viewpoint. So Eskom is the one cloud that has complicated the cycle more than any others. But at the same time, we think that there's a silver lining that comes with that in terms of very inexpensive opportunities to invest in.
It's so interesting because if you go back a year in the United States with inflation at 9%, who would have thought that a year later it would be down to 3%? Well, if some people did think so, but while it was at 9%, there were many who were saying it was going to go higher or stay higher for longer. So it's a similar kind of exercise, looking through the short term, getting out of the noise, looking ahead. And what do you see ahead when earnings do normalize in the amongst South African companies listed on the JSE?
Yeah, I mean, the here and the now is uncomfortable. So don't get me wrong. We don't just sit here quietly and be unemotive and look forward. I mean, it has been a very difficult 6 months. I mean, we can't ignore that. What we see is very much along the lines of you just painted. You know, we as South Africa sit with this. We call it the vortex, and I don't want to get into the detail of it. But you have a weak rand, which leads to supply side inflation, which leads to high interest rate, which leads to structurally lower growth. Because our interest rates have been high for, I mean, we can go back 12 to 13 years. Our interest rates have been too high. But the Reserve Bank's done its constitutional mandate very well. So we're not pointing fingers, but that is the reality. Our weak rand has caused inflation, high interest rates, low growth. And we think that the issue you alluded to is playing out slower than we would have hoped. That globally the supply side inflation pressures are alleviating. We can point to any number of those leading indicators that have rolled over quite dramatically. Our inflation numbers, whether it's this week or next month or next quarter, our inflation numbers or elevated base, the base effect starts working in our favor at some stage. And with that, you start to see that cycle sort of, that vortex break. And every other cycle we've been through this vortex, and we can point to 5 or 6 over the last 35 years, inflation has been the pillar that falls first. and then you get out of that uncomfortable vortex. So that's the part, the cyclical part I was trying to refer to earlier. So I think looking forward, currently with bond yields sitting at 12, and bond yields are boring, but they're important. But bond yields sitting at 12, you can understand why some company PEs are trading at 8 or 7, because our cost of capital is so high. But bond yields are 12 because inflation's high and the rand's been so weak. And if you get out of that vortex, bond yields start to normalize, which is a long way lower than 11.5 or 12. You start being able to pay better earnings, better multiples for future earnings. So that's the one side of the equation. The second side is we've actually been through those. We list 15 companies that we own, and those 15 companies, including a difficult 23, are likely to show compound earnings growth by up to 2025 of around 10 to 11% per annum, which is above inflation. It's not exciting, but it's pretty good. And what you're having to pay for those earnings is extraordinarily attractive relative to long-term history. So I guess that's the sort of overall context to why we're slightly more constructive on some of the opportunities to invest in here.
Many asset managers have taken full advantage of the 45% that they now are allowed to put into international stocks. You, however, have launched a brand new fund only in South Africa, the ClucasGray Asset Management SA-only balanced fund. Who's going to want to invest in that given all the noise at the moment?
No, so look, we run an equilibrium fund, which is the typical balance fund, which is allowed to go up to 45%, and nothing changes there. That still remains a flagship fund of ours. It's been going for 8.5 years and performed well at its objective of delivering industry-leading real returns, and the performance has been good for a sustainable period of time. So that nothing changes there. We think it's because of the 45% allocation allowed offshore that there's a scope for us as specialists in domestic assets, be that fixed income or equities, and asset allocation between those. We think there's a scope to manage the 55%, if that makes sense, of large institutional mandates. So we have developed a skill set over long periods of time in South African assets. Increasingly, the risk for our industry as asset managers is that 45% may well be managed more directly by the large offshore managers who have feet on the ground. And so I guess a little bit against the grain, we tried to offer a product that ring fences our skill set around that domestic only portion of the balance fund. And right now, the variability in offshore allocations between balance funds, as your show has highlighted, some would be as low as 10 or 12%, and some will be right up to the max at 45%. The variability in returns for balance funds is going to be enormous. Looking forward for the next, we saw snippets of it in the first 6 months of the year when you had the Russian crisis, or the Russian ship that got found at Simonstown, and all the events that followed that revelation. You've seen significant divergences in balance funds, and similarly in June when things reversed, you saw significant divergence of balance funds because the offshore weightings are so dominant. So never before have we had a period where the offshore weighting of a balance fund has been so key to the overall outcome of that particular fund. So it's not a point in time issue that we think that just right now SA-only assets are the way to go. We think that sustainably through the cycle, as the pension fund industry is allowed to invest that much offshore, we think there's scope for specialization. We will specialize in this SA-only component, which we think is something we've demonstrated a skill set and have experience in. And then we think increasingly there's a chance that gatekeepers will allocate some of that money to specialist offshore managers.
Makes a lot of sense. We, in the Biz News model portfolio, and I keep referencing you and Pitt Viljoen, and I see Dylan Bradfield saying the same thing, buy local because it's cheap. Last month, in the Shift portfolio, we put some money into the MSCI South African Index Fund listed in New York. And it's done 8% in the last month in dollar terms. So it's just showing that there are opportunities there, and it's almost like there's a blockage in most people's minds that you shouldn't be investing in South African equities. But you keep proving that that's not the case. That Reinet, for instance, which you put in our portfolio, thank you to Andrew Vintcent, has been a fantastic performer, and I see it's still one of your top stocks.
It is. We do like it. along with others. I think what's unique about that is it plays to a theme that we discussed right in the beginning around energy independence. But the broader theme you allude to is the attractiveness of MSCI South Africa, I think is real. We've touched on it. I mean, Reinet would be in our top 5 holdings, as would 2 banks and a large life company. And these are typically not businesses one would get too excited about. But I think that the opportunity set, the ability for these businesses to drive in a sort of self-help way, to drive the value unlock process, we think is pretty compelling. So we do see significant opportunities. I don't know what's in that MSCI South Africa index. Those things change quite frequently, but the concept of investing in domestic assets is appealing. And if we go back, Alex, sorry, I'm going to just throw it around a bit, but if we go back to previous cycles, the gap at valuations between South African-only assets and the US indices is as extreme as it was. It's more extreme than it was in 2002. And coupled with that, the currency, if currencies ever normalize back towards what we deem to be their fair value, and that's a big if in this country, as we alluded to earlier, if that ever happens, the cycle looks very similar to what we experienced in the early 2000s. Very weak rand and relatively very inexpensive domestic assets amongst a whole lot of companies, including something like a Reinet.
Well, thanks for giving us context on that, because investing is a long game and you can really get caught up in the day-to-day. And right now, judging by my inbox, it's been a long time since South Africans have been quite as negative as they are at the moment. But we're having fun in between it, even in the investment world, with a fantasy fund manager, which you are. ClucasGray is one of these sponsors of. I made a terrible mistake over the weekend by switching out of my favorite stock, one of my favorite stock, Textainers, into Richemont, because Richemont was supposed to be such a winner, and it took an awful dive yesterday. Maybe you can tell us why it did that. And secondly, I suppose that's what fantasy fund managers are all about, is to have a bit of fun and to learn as you go forward.
Yeah, look, I mean, I would be the wrong person to speak to. My form has been pretty poor since inception. Starting in May, it proved to be a difficult month for all. More difficult for those who had a slight bent towards some of the inexpensive domestic stocks. But so my portfolio hasn't included Richemont, but it's included others. That's been a relatively low turnover portfolio. But certain shares that I think happen to be way too cheap. I just haven't yet re-rated. I'm playing the slightly longer game, even though it's only a 6-month competition. I'm pretty sure the back nine is going to be better than the front nine for me. So that's where I sit. As it pertains to Richemont in itself, I mean, it's been the most extraordinary performer over time. And it just shows you what happens if slight. I mean, they were quite a good update, but a slight disappointment can be met in this market where things are quite fickle and everyone's a bit edgy. I think slightly negative news can be met quite brutally. But nice, not to take anything away from Richemont, still remains an amazing company, maybe slightly full from a valuation point of view. But I mean, I chose in that Rand hedge component, I've been choosing British American Tobacco for 10 weeks. That has been extraordinarily disappointing. Even with the weak Rand, it just keeps getting weaker. It's back to levels now where it was in pounds, not far from the COVID crisis low. So this has been a mystery. Yeah, so I feel your pain, but in a different name.
Yeah, no, Richemont, that wasn't the smartest move over the weekend. I should have just stayed with where I was. But why are you guys involved in the fantasy fund manager? What's the thought? Is it because you're just having fun within ClucasGray, or perhaps to encourage the broader public? And we've got more than 4,000 people who've signed up to take a more active interest.
Yeah, it's a wonderful initiative driven by Corinne, and yourselves have been actively involved. We like the fact that it is exactly what you talk about. It's introducing people to the joys of investing. For some, it will be a passion that they will have for the rest of their lives. For some, it could be a very stimulating and at times stressful career. But ultimately, getting more and more people to actively involved in individual stock selection and investing, we think is a huge. It's a life skill. It exposes many more. We'd like to think that next year there'll be more than 4,000 people. Exposes many more people to the benefits of compounding over time. And ultimately, this is if you go back and read some of those great investment books, the Peter Lynch books of the 80s, all the Warren Buffett books everyone had read, it just talks to investing is ultimately, it's everyday life. You walk past shops and trucks carrying branding and factories and good businesses or financial services companies, and you want to get involved in them. And the stock market does give you a way to take a view, express a view, and to back that view with funding. So we think it's a wonderful initiative. We love the gamification of it. Obviously, 1 week returns are relatively less significant over time, but it's the concept that it's fun, it's a game, it's a hobby, and for some, and hopefully for many, could become a long-term career.
Indeed, it can be not just 1 week, but even 1 day, as I felt the pain, as you say, with Richmond. But overall, it really is a lot of fun, and it is a way of the rest of us amateurs, putting ourselves into the shoes of you professionals. And how you do this on a day-to-day basis is beyond me. It takes stress to a completely different level. And in your case, you're actually dealing with people's money. Just to close off with, Andrew, how do you do that? How do you keep your stress levels under control?
I think it's part of it's part of the job, Alec, and I don't want to sound all-knowing. It is at times stressful, but it's ultimately we've developed a process over long periods of time we can fall back on it, and that process takes out some of the emotion and some of the day-to-day stress. We do look at the horizon. We do look 3 years out to try and get a sense of compound returns. We know that we fundamentally are buying inexpensive shares that should deliver returns over periods of time. We'll make some mistakes. The difficulty in our game is that your view doesn't play out overnight. And there are lots of macro events, domestic or global, that can derail that view in the shorter term. But I guess grey hair, a long time of doing this, you realize that if you stick to your process and you back your process, hopefully more times you'll be right more times than you're wrong. But yeah, not to minimize the emotive side of it. We can't. The behavioral finance side of investing is real. We like to think we find a way to manage it. I can promise you that going away to the wild coast, as we did last week, where there's no signal, is a wonderful way of getting away from everything. And coming back and turning your phone on, seeing the rand is still weak, but 100% stronger than it was against the dollar the week before, is quite satisfying.
Rather uplifting. Andrew Vintcent is portfolio manager at ClucasGray, and I'm Alec Hogg from biznews.com.